Will S&P 500 break the 7,500 barrier? This video is your fast, data-driven update on the S&P 500 forecast for next week. We are covering the institutional flows, gamma levels, and trade setups you need to stay ahead. The market is flat. The news is quiet. And that, right there, is the biggest trap of the week. We are sitting at a critical inflection point where one wrong move could cost you the entire month's gains, or set you up for a massive, low-risk scalp. There is one danger zone and one hidden opportunity right now. I'll show you both. Stay to the end. I'm giving you 3 exact levels you can trade today. Here is the session bias. The S&P 500 is range-bound, but we are drifting dangerously close to a major support zone. The invalidation level that flips everything is 7,475. Write this number down right now. If we see a clean 15-minute close below 7,475 today, the entire structure resets, and we are looking at a rapid flush toward the 7,450 level. The herd is complacent. Everyone is waiting for the Fed, and that means they are trapped on the wrong side of the trade. The market is a weighing machine, and right now, the weight is tilting to the downside. Alright, let's zoom out to the weekly chart. The trend is still a strong buy, but we are seeing significant exhaustion. The price is trading at 74.73, and the 200-week moving average is way down at 68.90, so we are well above it, but we are starting to see a stall. The daily trend is showing a buy signal, but it's weak, and the 5-hour and 1-hour trends are neutral and sell, respectively. This conflicting time frame analysis is what makes this setup so compelling. Let's drop down to the 4-hour chart. This is where the battle is being fought. We have that key pivot point at 74.93, and the price is currently struggling to stay above it. The 20-period moving average on the 4-hour is sitting right around 7,450, acting as a secondary floor. The ADX is at 23.9, which tells us the trend strength is low. We are in a coiling pattern. The MACD on the daily is showing a positive value of 37.32, but momentum is decelerating. Look at this 4-hour negative divergence. Buyers are simply exhausted. They can't push it higher. Now, let's get to the exact levels. The crucial support levels to watch are S1 at 74.75, S2 at 74.50, and S3 at 74.32. For resistance, we have a 1 at 75.18, R2 at 75.36, and a 3 at 75.61. We are essentially pinned between these levels. The RSI is at 53.25, which is neutral. No one is oversold or overbought. The CCI is at 10.57, and the Williams percent R is at -38.6, again telling us we are in no man's land. Here's what most traders miss. When the market is this compressed, the breakout, in either direction, is often violent because it triggers stops on both sides of the range. Look at the volume, or lack thereof. This is the calm before the storm. The ATR is 113.9, which is showing volatility is not dead. It's simply waiting for a catalyst. Here's the hidden divergence no one is talking about. The S&P 500 is tracking a descending channel while the VIX, the fear gauge, is starting to lift its head. As yields continue to put pressure on equities, we are seeing a divergence where the price is making slightly lower highs, but the momentum on the 1-hour chart is stalling. The 5-hour trend is neutral, but the 1-hour trend is clearly a sell. The smart money is selling the rips into the 7,518 resistance zone. They are building short positions right below this level. The Fed signals are keeping rate risks in focus, and that is a headwind for high-valuation tech stocks, which are a massive part of the S&P 500. The next signal changes everything, and that signal is a break of 74.75. The news is flat, stocks are flat, and oil is falling as rate worries offset any optimism from Iran talks. This is the perfect fundamental cocktail for a sideways grind. But the narrative is shifting. Yesterday's Fed speakers didn't give any dovish surprises, so the market is repricing the possibility of another rate hike. This is the dollar killer and equity killer narrative. We are now building a narrative web. Higher for longer rates, falling oil, which is disinflationary, but also a sign of slowing demand, and flat equities. This creates a data void that the market hates. Right now, the 1 to 2 week directional lean is to the downside, and that bias remains as long as we stay below the R1 level of 7,518. The event that invalidates this is an aggressive dovish pivot from Fed Chair Powell. But for now, the data says the path of least resistance is to test that 7,450 support. Do you think the S&P breaks 7450 this week? Comment yes or no right now. I'm tracking consensus. Most people skip this section. That's exactly where the money is made. Keep watching. Strategy 1, the sniper, conservative. This is for the risk-averse trader who wants to play the range breakdown. The trigger condition is a clean 15-minute candle close below 74.75. I want to see the momentum shift. The stop loss will be placed just above the 4-hour resistance, at 75.18. That gives us a tight risk. The target is a quick move to the S2 level at 7,450, and if momentum is strong, we look for a flush to the S3 at 74.32. This setup gives you a risk-reward ratio of over 1 to 3. Strategy 1, the sniper, conservative, entry, 7,474, 15-minute close below, stop loss, 75.18 take profit 1, 74.50 take profit 2, 74.32 risk, air reward, 1:3.2 hour invalidation, void if price holds above 7,485 for 30 minutes. Strategy 2, the active trader, mean reversion. If we see the price reject the 7,450 level aggressively, that is our entry. The market is oversold on the intraday charts. We'll look for a bullish hammer or a bounce off the 200-period moving average on the 1-hour chart around that level. Entry is at 74.52, with a stop loss just below the 7,432 level. The first target is a retest of the pivot at 74.93, and the second target is the R1 at 75.18. Once target 1 is hit, you move your stop to break even and let the runners go. Strategy 2, the active trader, mean reversion, entry, 7,450, 1H. Bounce plus bullish confirmation, stop loss, 74.30 take profit 1, 74.93 take profit 2, 75.18 risk, reward, 1:2.1 hour invalidation, void if price closes below 74.32 on 4H timeframe. Strategy 3, the aggressor, high risk. This is for those who can lose small. If we see a fake out above 75.18, a liquidity grab, and then a swift reversal back below that level, you short the rejection. Entry at 75.08, stop loss at 75.36, and target a crash back to 74.75. This is countertrend, or a momentum chase on the shorter timeframe extremes. Only for those who can manage risk aggressively. Strategy 3, the aggressor, high risk, entry, 75.18, false breakout reversal, stop loss, 75.36 take profit, 74.75 risk, air reward, 1:2.0 hour invalidation, void if 4H candle closes above 75.36, 8:10, aggressive play. This is a pure scalp on volatility. If the market makes a new high and then collapses, the panic is what drives it lower. It's a zero-sum game, and you want to be on the side of the stop losses. Never risk more than 1 to 2% per trade. No positions through high-impact news like CPI or FOMC minutes. Stops are non-negotiable. This is how you survive to trade the next big move. So, let's summarize the single most critical level for tomorrow's session. Watch 74.75. A break below, and we are looking for that downside acceleration. A hold, and we are back in the range, waiting for the next Fed clue. Tomorrow, we are watching the jobless claims data. A surprise to the upside could seal the deal for the bears. If you want the full breakdown on Bitcoin and the S&P divergence, that video is live now. Tap the end screen. Smash like if this gave you a clear plan. Subscribe, hit the bell, and I'll see you in the next one. Remember, the market is always in control. We are just here to trade what it gives us. Stay sharp.